Thank you for standing by, and welcome to the Limeade First Quarter Investor Conference Call. All participants are in a listen-only mode. There will be a presentation followed by a question-and-answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Mr. Henry Albrecht, CEO. Please go ahead.
Thank you, operator, and thank you all for joining the call today. My name is Henry Albrecht, CEO of Limeade, and I'm here to present our cash flow results for the quarter ended 31 March 2021. Joining me today is Adam Smith, Director of Finance at Limeade. During Q1 2021, Limeade signed 3 new enterprise contracts, 2 new U.S. enterprise well-being solution customers, including a large U.S. retailer, and 1 engagement solution customer in Europe. In the prior corresponding period, the company signed 5 contracts. I remind investors on the call that our contracting cycle is heavily weighted to the second half of the calendar year, with sales often leading to launches in the first quarter of the following year. The level of contracting is within expectations for the quarter. We were very pleased to execute on our 5th annual Limeade Engage conference held in March. Like in 2020, this was a virtual event. As a recap, Limeade Engage provides leaders in well-being, benefits, HR, and related fields the tools and inspiration they need to infuse care into the employee experience. Limeade Engage represents an important event that supports customers and generates new business leads. The number of registrations in 2021 exceeded 2,300, 275% more than last year's virtual event. 545 registrants were employed by new business prospects with 5,000 or more employees. This represents growth of 268% versus 2020. From our perspective, these are pleasing numbers at a time when employee well-being and care are at the forefront of corporate objectives. Turning now to pipeline. The company's total sales and marketing pipeline at Q1 2021 recorded a decline of 19% versus Q4 2020 to $182.4 million, which was driven predominantly by a decline in the early stage qualifying or marketing pipeline. Our overall year-to-date net revenue retention, NRR, was 98% as at 31 March 2021. Our recurring subscription revenue from the existing customer base remains solid, with our top 20 customers on average having 18 months remaining on their contracts. Before I walk you through the financials, I wanted to provide an update on the recruitment of a new CFO for Limeade. The company and its recruitment advisors have identified a number of high-caliber, experienced candidates for the role, with the interview process now well advanced. We expect to announce the successful candidate in the coming weeks and look forward to introducing this individual to investors in due course. I will now provide a brief summary of our quarterly cash flow information as released to the ASX this morning. I'm pleased to report the company remains in a solid financial position with our cash position of $31.3 million as at 31 March 2021, remaining largely unchanged from the fourth quarter of 2020. Accordingly, Limeade remains well positioned to capitalize on both organic and inorganic growth opportunities during 2021. In addition, we have $15 million in undrawn debt available to the company. In Q1 2021, we recorded positive operating cash inflows of $0.6 million, all dollars USD. Although these positive operating cash flows were down 69% versus the prior corresponding period due to lower FY 2020 contract signings during the COVID-19 period, as previously disclosed to the market. For the quarter, the company recorded cash receipts from customers of $23.6 million. Net cash receipts from customers after adjusting for payments made in relation to the sale of third-party products and services was $17.1 million, down 8% versus the PCP. Third-party payments of $6.4 million were down 6% versus Q1 2020, but up 177% compared to Q4 2020. Cash payments during the quarter were primarily directed towards the following costs: staff, $10.6 million, administration and corporate, $3.5 million, operating, $0.8 million, marketing, $0.9 million, and research and development, $0.8 million. Staff costs decreased 17% versus the PCP, reflecting a reduction in staff cash bonuses paid following the FY20 result. Overall, Limeade headcount continued to track at a lower rate than prospectus forecasts due to company efficiencies and reduction in hiring associated with general business uncertainty during the COVID-19 pandemic. Investing cash flows for the quarter of negative $0.8 million reflect software development costs incurred during the quarter and remain consistent with prior quarters. I'm very pleased to reaffirm our FY21 guidance, which is revenue of $50 to $53 million and EBITDA loss of $5 to $8 million. We remain optimistic about a sustained recovery in our growth profile, which has exhibited 5-year revenue compound annual growth rate, or CAGR, of 24% and CAR CAGR of 15% for the period FY15 to FY20. We're excited by what 2021 holds for Limeade, with business conditions improving, vaccination rates increasing, and the unemployment rate falling to 6% from pandemic highs of 15% in the U.S. The need for innovative well-being and related employee experience solutions has never been stronger. I would now like to hand over to the operator for the question and answer session.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Seth Hoskin with Canaccord Genuity. Please go ahead.
Hey, Henry, how's it going? Thanks for taking the questions this morning or afternoon for you guys. So just quickly on the NRR, so that's tracking at 98% year to date. Just kind of a bit of a clarification question. Is it fair to assume that typically sort of the churn events will be naturally second half weighted along with the sales cycle, or is the bounce back in 1Q sort of a better indication for the rest of the year?
I think historically, we try not to get too caught up in quarter over quarter. You know, churn can happen at any point in time. Historically, we have seen slightly higher rates of churn in the second half of the year than in the first half. So I wouldn't overread positive or negative into the churn.
No, that's really helpful. And then just in terms of sort of the headcount and open vacancies across, or I suppose hiring intentions over the next 6 to 12 months, are they sort of incrementally, are you looking to add to the headcount, or is it still sort of wait and see in terms of the sales roles?
We do have open headcount across the company. We have a couple dozen open headcount, and we're always recruiting. I think in the general expenditures, like I said, we're more or less on track with our EBITDA losses, and headcount being the majority of our expenses. We expect to see, a small increase in headcount over the course of the year, but not a massive expansion.
And are they largely in tech roles, or sort of, I suppose, software development, or is it a bit of a broad mix?
It's spread across the different departments of the company. We do see a lot of opportunity to continue to invest in our market leading technology, but we do have roles across the company open.
Cool, thanks, Henry. And just one final one, just in terms of the pipeline. Is that sort of just a bit of natural movement, I suppose, a bit of colour on that 20% decline, and I suppose it's at the top of the funnel, so as important as the bottom, but just is that HR buyer pressure budgets kind of the reason for them moving out?
Yeah, Seth, we do see some of this fluctuation. It's just a natural, quarter over quarter fluctuation that happens, either positive or negative, first of all. A few more points on that. Primarily the change we saw was in what I would call the top of the funnel marketing pipeline. And some of that is, we have been generating more throughput there. I mentioned the 275% increase in attendees at our conference. it's possible that we're generating some marketing pipeline that just doesn't make it into the sales pipeline. Either they were never qualified in the first place, or we're just kind of generating more demand that's not a perfect fit for what our solution does. The second point I would make is that some of the pipeline that pushed from 2020, the COVID era, into 2021, some of those budgets are still not approved, and so we closed some of those opportunities. If we don't feel like we're certain that they can close in this calendar year, we'll push them out. The pandemic in the U.S., for a little color from my perspective, it's still in the top story of the news most nights here, and we still are struggling with it. I know here in Washington we're at 25% fully vaccinated. I think until we get maybe above 50 or 60%, the full corporate confidence will come back. And so that's probably the second comment. And then lastly, I would just say we feel good about our pipeline still. It's still ahead of our pre-IPO levels, and there is a return to purchasing cycles that we believe bodes well for the return to growth that we've spoken about.
Cool. Thanks, Henry. Really appreciate the time.
Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. Your next question comes from Tim Lawson with Macquarie. Please go ahead.
Hi, Henry. Thanks for taking my questions. Just 3 questions. In terms of 3 contract wins, can you talk about the timing of their start, maybe the sort of size and what that's done to your ARR?
We're not disclosing at the quarterly cash flows the size of the deals or the ARR. We just gave a couple teasers on the nature of the deals being U.S. well-being for 2 of them, and engagement and employee experience in Europe for the 3rd.
And were they expected when you set your guidance, these 3 wins?
Yeah, I think we normally see fewer wins in Q1 and Q2. As you know, we're in the calendar years, our fiscal year as well, and then much more backloaded. So we feel like this is that expectation for where we should be at this point in the year.
Okay, and then just I appreciate it. You've mentioned churn's typically higher in the second half, but in terms of what you're seeing at the moment, is there anything to suggest that churn isn't consistent with what your guidance expectations are?
No.
And I guess the same question for the pipeline movement. You also had a previous question on that early stage pipeline movement, but again, is that consistent with what you're thinking about from a guidance point of view?
Yes, it's consistent.
Okay. Thank you.
Thank you, Tim. Appreciate the questions.
Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. There are no further questions at this time. I'll now hand back to Mr. Albrecht. Pardon me. We do have a question from Sean Kumar with Chambers Global. Please go ahead.
Hi, Henry. Thanks for taking my question. Can you speak to your expectations for just growth of new customer acquisitions over the second half of the year, kind of relative to what you were thinking at full year results?
Although we don't project our contracted annual recurring revenue or bookings throughout the course of the year, we are reaffirming our guidance on revenue and EBITDA. So that's as far as we're going in the 4C. We are discussing perhaps expanding our disclosures at the mid-year AGM or at the mid-year results. So that's when maybe we may revisit that question, Sean. Thank you for it.
Okay. And do I have time for one other quick one?
Yeah, of course. Yeah.
Okay, great. And just I'm curious your current views on and appetite for tuck-in M&A. Kind of given the environment and what you might be seeing out there in terms of opportunities.
Yeah, I mean, I would say the U.S. market is it's a bit frothy, as you know. The valuations in the U.S. HR tech companies can be anywhere from 5 to 30 times revenue, and that does present some challenges. Even that notwithstanding, we're seeing some exciting opportunities in the inorganic growth or M&A area that we continue to explore. At the start of the year, we said we did target one acquisition over the course of the year, and we are still thinking that way. And we do see opportunities both in the U.S. and in Europe and elsewhere, where we're having some interesting discussions, but nothing to report at this time. Just to reiterate also, we do have over $30 million in cash on the balance sheet and access to debt, so that shouldn't be a barrier to a smaller tuck-in acquisition at this point in time.
Great, thank you.
Thanks, John. Appreciate your time.
There are no further questions at this time. I'll now hand back to Mr. Albrecht for closing remarks. Pardon me, we do have a question from Dee Mitchell with AEI. Please go ahead.
Morning. I just wanted to ask two questions. The first one is just in terms of the client wins. Were they off a competitor, or are these white space client wins? Just interested in your views in terms of penetration. And then the second question is just as on competitors in the space. And there's been obviously a lot of discussion about the well-being. What changes are you seeing in the competitive landscape? Thanks, Henry.
I actually don't believe we've ever recorded whether we're winning over specific competitors or competitive in general. I'd like to, if you don't mind, not answer that question directly, but maybe give a more general answer, which is in the vast majority of the sales deals that we compete in, there is an incumbent technology vendor. Sometimes it's a first-generation vendor, a vendor that's been installed for a while. And in most cases, we are actually replacing an existing vendor with a new technology, which speaks to this market going through a stage of maturing and maybe looking for a fresher, newer technology approach that can reach more people and have more capabilities, et cetera. So I would say well over 80% of the sales we make, it's not a new to the world sale, it's a replacement sale. Second part of your question. Dee, help me out here. I got into the first part and forgot the second part.
The second one was just about competition in the space.
Oh yes, yeah. Sorry, I wrote down competition. I didn't know what I meant. So I mean, this is a competitive market that Limeade plays in. There's two elements of competition in our core business, which is the well-being business in North America. It's a highly competitive market. We've seen some competitive flux. There's been last year we saw a couple of companies go out of business that were formerly competitors, but we've also seen increased investment in the space. So I would say the competitive dynamic, although still highly competitive, hasn't changed in material ways. There has been, on the employee experience story more broadly, I think there's been some really exciting competitive dynamics, specifically the introduction of Microsoft Viva, which I think has a core underlying platform to a vast array of HR systems, from system of records to payroll to learning to benefits and wellness, et cetera, I think presents a whole new level of air cover and support for the employee experience market, very broadly defined, as a key software market, just like CRM was 10 or 20 years ago. I believe the employee experience market will get the same level of attention and focus. And we view that as very positive for Limeade as a pioneer in well-being, with the COVID-19 pandemic putting much more attention on some of the topics that we focus on as the core of our business, like communicating with hard-to-reach people, supporting people who feel socially isolated, helping people with mental and emotional health issues, including stress, depression, addiction, and more, and also helping people stay active and healthy to not just to survive the pandemic, but to survive and thrive in their lives at work, and even facilitating third-party services like vaccinations and screening. So we view that the long-term tailwinds brought about by this pandemic support the core Limeade value proposition, even in the face of some short-term demand challenges given corporate spending, specifically in benefits departments. So competitively, I would say in well-being, still strong but nothing radically different in employee experience, perhaps broadened and market supported more by some of the mega vendors entering into kind of the platform space underneath what Limeade does.
Thanks, Henry.
Thank you, Dee, for your question. Appreciate it.
Your next question comes from Ross Barrows with Wilson's Advisory. Please go ahead.
Great, thank you. Just one question on the net revenue retention. So looking at it historically, it's been around that 97-98% mark, obviously softened in the 20-year and kind of back to that level now. What's your expectation? Would you expect that to be something that would grow over time as, I guess, the penetration and the knowledge of the customers you're working with improves?
Yeah, our expectation is that COVID was an anomalous situation, and that although we're still at I hope the tail end, I hope not the middle or the early stages, but at the tail end, we do expect the NRR to increase over time with a long-term target in our NRR well over 100%, which is part of why our strategy to expand globally as well as expand with additional offerings and solutions for our customers. So right now we're not giving specific guidance to NRR, but we do expect a long-term trend to increase that as a software company in the post-COVID era.
Thank you.
Thank you. Appreciate your question.
There are no further questions at this time. I'll now hand back to Mr. Albrecht for closing remarks.
Thank you, operator, and thank you all for joining the call today and for your questions. We look forward to updating the market throughout the remainder of 2021 on our progress towards our stated objectives. I hope and trust that all of you in Australia and New Zealand have a nice Anzac Day on Sunday. Thanks again from Limeade. Onward.
That does conclude our conference for today. Thank you for participating. You may now disconnect.